Welcome to Luck Scout Economic News and Strategies. Today, I testified before Congress to shed light on the Federal Reserve's current thinking and our plans for interest rates.
Powell's comments come at a time of heightened uncertainty for the U.S. economy. Inflation, while easing, remains stubbornly above the Fed's 2% target.
Chair Powell, investors and consumers alike are closely watching the Fed's every move. Higher interest rates make it more expensive to borrow money, impacting everything from mortgages and car loans to business investment.
When the Federal Reserve raises interest rates, the cost of borrowing money goes up. This impacts consumers and businesses alike.
Higher rates mean more expensive mortgages, car loans, and credit card debt. This strains household budgets, especially with inflation.
Businesses also feel the pinch. Loans for expansion and operations become more costly. Startups may find it challenging to secure financing. When interest rates climb, investors often shift their strategies, seeking to protect their portfolios and capitalize on new opportunities.
Bonds, particularly those with fixed interest rates, tend to lose value as rates rise, making them less attractive to income-seeking investors. However, newly issued bonds with higher yields can become more appealing.
In the stock market, sectors considered defensive often fare better in a rising rate environment. These sectors, such as consumer staples, utilities, and healthcare, tend to be less sensitive to economic fluctuations and offer more stable earnings. Investors may gravitate towards these sectors as a safe haven during times of uncertainty.
Growth stocks, on the other hand, often face headwinds when interest rates rise. These companies, typically in technology or other innovative industries, rely heavily on future earnings growth to justify their valuations. Higher rates can make it more expensive for these companies to finance their growth, potentially impacting their profitability.
Investors seeking to navigate a changing interest rate environment need to carefully assess their risk tolerance and adjust their portfolios accordingly. Diversification across different asset classes and sectors remains crucial to mitigating risk and achieving long-term investment goals. Recent reports indicate a surge in wholesale inventories, signaling that businesses are accumulating goods at a rapid pace. This buildup in inventories could be attributed to several factors, including easing supply chain disruptions, concerns about future inflation, and expectations of continued consumer demand.
While a healthy level of inventories is essential for businesses to meet customer demand, excessive stockpiling can be a double-edged sword. On the one hand, it suggests confidence in the economy and could indicate continued growth. On the other hand, if consumer spending weakens or demand falters, businesses may be left with a glut of unsold goods, potentially leading to discounts, lower profits, and even job losses.
Investors are closely watching inventory levels as a key economic indicator. A sustained increase in inventories could signal slowing economic growth in the near future, while a decline could point to stronger than expected demand. Understanding the dynamics of inventory cycles is crucial for investors seeking to make informed decisions. Oil on the rise: what a crude surplus means for you. Crude oil inventories have been rising, exceeding analysts' expectations. This surplus can lower oil prices, benefiting consumers but challenging energy companies.
Factors include increased OPEC+ production and global economic concerns. Geopolitical tensions and the war in Ukraine add uncertainty.
Lower prices can relieve inflation, boosting disposable income. But for energy businesses, it means reduced profits and job losses. Key takeaways: what investors should watch. The Federal Reserve's commitment to fighting inflation, coupled with recent economic data, presents a complex landscape for investors. Here are some key takeaways to consider. Interest rates. The era of cheap money is over. Expect further interest rate hikes as the Fed continues its battle against inflation. This will impact borrowing costs for individuals and businesses alike. Market volatility. The stock and bond markets are likely to remain volatile as investors digest economic data and adjust their expectations for future interest rate hikes. Defensive positioning. Consider shifting a portion of your portfolio towards more defensive sectors, such as consumer staples, utilities, and healthcare, which tend to be less sensitive to economic downturns. Global factors. Keep an eye on global economic growth, geopolitical developments, and commodity prices, as these factors can significantly impact the U.S. economy and financial markets. Long-term perspective. Don't panic. Market fluctuations are normal. Maintain a long-term investment horizon and focus on your financial goals. The Fed's balancing act: inflation versus recession. The Federal Reserve faces a delicate balancing act in its quest to tame inflation without triggering a recession. Raising interest rates too aggressively could stifle economic growth, while moving too slowly could allow inflation to become more entrenched.
The Fed must carefully analyze economic data, including inflation, employment, consumer spending, and business investment, to determine the appropriate pace of interest rate increases. It's a complex and challenging task with no easy answers.
Some economists argue that the Fed is already behind the curve and needs to raise rates more aggressively to get inflation under control. Others contend that the Fed should proceed cautiously, as raising rates too quickly could unnecessarily harm the economy.
The Fed's decisions will have far-reaching implications for consumers, businesses, and investors. Its ability to strike the right balance between inflation and economic growth will be closely watched in the months ahead.
Global impact: how U.S. interest rates affect the world. The U.S. dollar plays a dominant role in the global financial system, and changes in U.S. interest rates can have significant repercussions around the world.
When U.S. interest rates rise, it can make dollar-denominated assets more attractive to foreign investors, potentially leading to a stronger U.S. dollar.
A stronger dollar can make U.S. exports more expensive for buyers in other countries, potentially harming U.S. businesses that rely on international trade.
It can also make it more difficult for developing countries to repay their dollar-denominated debts.
Conversely, when U.S. interest rates fall, it can make the dollar less attractive to foreign investors, potentially leading to a weaker dollar.
A weaker dollar can make U.S. exports more competitive and boost the profits of U.S. companies operating overseas.
The interconnected nature of the global economy means that the Fed's interest rate decisions have implications far beyond U.S. borders. The long view: interest rates in a historical context. Understanding the historical context of interest rates can provide valuable insights for investors. Interest rates have fluctuated significantly over the past several decades, influenced by economic cycles, inflation, and government policies. In the early 1980s, the U.S. experienced a period of high inflation, prompting the Federal Reserve to raise interest rates sharply to combat rising prices. This led to a recession but ultimately helped to bring inflation under control. In the aftermath of the 2008 financial crisis, the Federal Reserve lowered interest rates to near zero to stimulate the economy. These low rates persisted for several years, contributing to a period of economic expansion but also raising concerns about asset bubbles. The current period of rising interest rates marks a departure from the ultra-low rates of the past decade. Understanding how interest rates have behaved in different economic environments can help investors make more informed decisions. Preparing for the future: what consumers can do. In an environment of rising interest rates and economic uncertainty, it's more important than ever for consumers to be financially prepared. Here are some steps you can take. Create a budget. Track your income and expenses to identify areas where you can cut back and save more. Pay down debt. High-interest debts such as credit card balances can quickly erode your financial stability. Prioritize paying down these debts as quickly as possible. Build an emergency fund. Aim to have 3 to 6 months worth of living expenses saved in an easily accessible account to cover unexpected events. Shop around for better rates. Compare interest rates on loans and credit cards to ensure you're getting the best possible deal. Invest for the long term. Don't let short-term market fluctuations derail your long-term investment goals. Continue to invest regularly and diversify your portfolio.
By taking these steps, you can better navigate the challenges of a high interest rate environment and build a more secure financial future.
Final thoughts: uncertainty and opportunity in the markets. The current economic environment is characterized by both uncertainty and opportunity. The Federal Reserve's fight against inflation, coupled with geopolitical tensions and slowing global growth, creates a complex landscape for investors to navigate. However, periods of uncertainty can also present unique opportunities for those who are prepared. By staying informed, managing risk, and maintaining a long-term perspective, investors can position themselves to weather the storm and potentially benefit from market fluctuations. Remember, investing is a marathon, not a sprint. By focusing on the fundamentals, diversifying your portfolio, and seeking professional advice when needed, you can increase your chances of achieving your financial goals. Please like the video and share it with others. Thank you for watching.